Welcome back, everyone. Today on the docket, we have Bannerman Resources. Before I begin, just the regular disclosure when I have to make it. As I do today, I own shares in Bannerman, but that does not make anything I'm going to say today investment advice. So this is another one that first time I looked at it, I didn't own it, and now I do. Now, why is that? Well, as I remarked when first looking at it, this is one that time passing, as the thesis develops, it gets more bullish. Why? Because the price, the price probably goes higher, and the likelihood of restocking increases. And to do that, you'd probably want to be in, if that were going to, if I could definitely say that both of those things were going to happen, I would definitely want to be in something like Bannerman. And I also thought about what does quality mean? Does quality necessarily mean the lowest cost asset, or can quality mean an asset that is less likely to burn value in the meantime, or an asset that is a company that is well managed maybe, or is a buyout target, or what does quality mean? That's another thing that I thought of over time. And I also thought, why Husab? And this was something that was on my mind for a while. Like, what happened with Husab? Why was the extract minerals? Why was it bought out? Or resources, one of the two. Why was it bought out, and why was Husab developed in a market where it would never make financial sense to develop a Husab? Because that happened. And you can look back at the prices the whole time since Husab was bought to now. It has never made sense to develop Husab economically. Now, and you look at Husab's cost structure, and I also thought about where would demand growth come from, and what would that mean in terms of security of supply? So these are a number of things that kind of I thought of, and over time changed my mind on a few conceptions that I had. Now, another thing I like to do when I can is kind of bounce around the bull and bear cases in my mind to try and come up with okay, well, what's the real problem here? What's the real good uh, bull case on something? What what is the answer to the market's question? And for Bannerman, I'm going to start with the very, very common bear case. And anytime you mention Bannerman to someone who was either on the fence or out of it, out of Bannerman, that I should say, not out of whatever, um, they would say, yeah, but where are you going to get 700 million in capex? And at $30 uranium, at $25 uranium, absolutely, 100%, I agree. Where are you going to get 700 million capex? It won't happen at these prices. But that was never really the huge issue for Bannerman. I mean, in addition to them working on reducing the costs, and I still believe if they were to redo the cost for the full Etango project, it would be lower. But in addition to that, you're not working off of a $30 uranium, $30 million market cap company needing to raise $700 million. And there's a lot of people that focused on that, and I just thought that that was a wrong question on a lot of levels. Why? Well, first off, no one wants to build a Tango with $30 uranium. Maybe with 75. And if we get to 75, and I'm just using the DFS numbers here, what's the market cap of the company going to be? Well, first of all, hopefully not $30 million. Hopefully not. I mean, maybe it could be. And in that case, they may be able to do some earn in or whatever. But hopefully the market cap would be larger at that point. So in reality, it's not as big a ask as it seems like. Now that being said, it's a lot of money for sure, 100% agreed. And but it's just everyone is focusing on that as the issue. And in reality, when you look at it, you look at the total cost structure, and I'm saying all in costs and not just like capex. You add the capex plus the opex, and really it's basically in line with most other companies, around 50 bucks. Most companies, when you look at the all in cost, are around 50 bucks per pound. And so when you look at that, you're like, okay, well, assuming that someone is looking for a sizable operation, and these are their options, and they're going to have to either pay a premium for under 50 bucks, or they can get their costs at 50 bucks. And if that is higher in capital costs and lower in operating, or higher in operating, lower in capital, it may not make that big of a difference for someone looking at a purchase. And so, yeah, it's a lot of capital, of course. But when you actually look at it on a grand scheme of things and compare it to per pound of production, it's really not that bad. And this is just a little aside. I'm not trying to poke fun at anyone or be mean to anyone, but it just it always makes me laugh when I see it because I've seen this a few cases, but it's often two separate instances where someone will say Bannerman's capex is way too high, and then later or in another context they'll say I'm going to make a ton of money with XYZ, and I'm XYZ is obviously not a actual uranium stock. I mean, right now at least, but it could be, it could be Paladin, it could be whatever, it could be whatever. But think about it. If you're going to make however much money you think you're going to make, it's probably because the price of uranium goes really high, maybe above 90 bucks, for example. And I'm just thinking, if you think the price of uranium is going to go above 90 bucks, for example, I mean, if I had absolute conviction in the price going that high, the only thing I would need to buy is Bannerman. And so I just find this bifurcation here a bit, I don't know, funny, I guess. One of the other things that I was thinking of while considering Bannerman was what leverage means. Now, I'm sure most of you know what leverage means in probably multiple contexts. The financial world is normally associated with debt. Normally, basically, you assume extra risk in the debt or whatever, pricing in some way, in order to try and achieve excess reward. As I said, most of the time this is done through assuming debt to buy something, build something, do something. So in this case, however, well, not however, in this case, the leverage comes from needing much higher prices, and 75, let's call it, in terms of the old DFS. So needing much higher prices in order to achieve the value. Now, it's interesting though, because they offset this with a really low burn. They don't burn through a lot of money. So what you get for very, well, a low price, because there's a low probability of it actually going into production at this price, obviously, and there's a lower probability of the price going higher, the more higher you want to guess that it goes. So in this case, yes, you need it to go a lot higher, but in reality, it's not going to be like 50 million, 50 million, 50 million, 500 million, and that's as the price goes 50, or sorry, 30, 40, 50, 60, 70. In reality, as we go along, the leverage kind of gets built in. So as the price goes up, the possibility of the big payday, if you will, becomes more probable. And so in that way, you have a lot of leverage, but you don't have a lot of leverage. And I'm saying this because you don't have necessarily as much downside leverage as you do upside because there's a very low burn. Now, if these guys burned like, I'm just going to pick on next gen here because they're the biggest junior. I like next gen, but I'm just saying they go through a lot of money because they spend a lot on their project. They have to spend a lot because developing big project. Bannerman's already developed, so they don't really have to burn as much money. If they burned what next gen burned, they would be practically worthless. But they don't. So they can have the upside potential without having the matching downside. So I just see this leverage being skewed in a way that makes sense. Okay, so now that I have talked about leverage and math and skew and all that boring stuff, I'm going to go into more boring stuff, numbers. I just wanted to talk a little bit about the Husab bull case. Now, to those of you who aren't familiar, Husab was, I spoke about this a little bit before, but basically a massive project in Namibia that was bought out and has never made a dollar for the people that bought it out. But that's all good because they wanted security of supply. So anyway, how does this affect Bannerman? Well, Bannerman using the old DFS numbers, and get to why I keep calling it the old DFS in a minute. Using the old numbers, their costs were $51 a pound approximately. That's all in cost. Again, they were probably going to be able to skim that down a little bit, but it's never going to be super low cost. Let's assume 51 for now. So if you care about returns, you'd need a higher incentive price, like $75 at least, to get the adequate returns to spend the money to build the mine. Again, can be cut down, but using old numbers. So what if the price is at 55? Well, for Bannerman, the Etango project, Bannerman's project that is not worth anything, unfortunately. Not worth much to them. But if someone else wanted to do it, wanted to develop it because they just wanted security of supply, well, they can either buy uranium on the spot market for $55 a pound or buy the Etango project in theory for $4 a pound, spend the 51 to get the pounds, and boom, there you have it. Same thing. So if you're Bannerman, you could say, well, we can split the difference. You pay $2 per pound in the ground, and you can produce. You could build the project, produce it. You get uranium for 53. We get $2 a share. Again, this is kind of undercutting a bit of the thesis here, but I'm just saying this is an example. Makes a deal could make sense for both sides, and everyone gets what they want. And I only mention this as relevant because the price of Bannerman per pound in the ground, and again, I hate that metric. I hate it. Dumb. I don't want to use it. But in this case, it actually kind of makes sense on some level. But the price for Bannerman per pound in the ground is 10 cents, 15 cents. So if you're talking $2, that's a substantial difference. And then we can look at, okay, well, what if the price is $60? You split it in the middle, it's $4.50 per pound. And again, I really dislike pounds in the ground, but I'm saying in the Husab case, that's really what was bought. And if you're looking at what a giant project in Etango could be worth if we get to a similar type of scenario where someone wants pounds in the ground, And just a side note, before you say, well, Husab's bigger, Husab, whatever, it's completely different. I agree, it is completely different. Etango is actually far more advanced and de-risked than Husab was at the time of the purchase. And while it is smaller, the capex is also significantly lower in the capital. So there's there needs to be considerations on both sides because Husab might have been slightly rushed in terms of what how it was moved forward. So most of this talk up until now has been focused on what I've been calling the old Etango. And I'm saying this relative to the Etango 8, which seems to be the new focus. Again, it's the same project, just kind of scaled down to a size that is more manageable, maybe more manageable in the market if you want to actually build it yourself and go it alone, and has smaller hurdle to production, if you will. And this again shows some of the cost savings that were kind of talked about and could be put into a newer version of the big Etango project, where I kind of said in the past, yes, they're probably going to get some of the costs down. This is some of it, but again, I'm not at all saying that, oh yeah, they're going to spend this much to make the small project and get the production of the old one. No, no. This is a different version, a different way to start, if you will. And so this is another option. I mean, I'm still thinking that if they can get the cost savings in the old one, it's the ultimate buyout target, if you will, if we get to that type of exciting cycle, or if maybe there's some countries that continue with their investments and they start looking into the future of where they're going to get their uranium. But this is a way for the market to, if things kind of just never really get exciting, if we only get to $65, maybe $70, and that was always a potential thought for Bannerman, is like, maybe we only get to 65, and then are they kind of SOL? And here they're saying no, no, we can make it work. And it's good to have that option, even though I believe that the big one is still the optionality play that I like in Bannerman, that I focus on in Bannerman. But again, it never hurts to have more options. Now, the other thing I want to mention is, even with regards to the big project, if you look at some of the deals that were structured in the last cycle for offtakes, that could be a way to get capital even for the big project. So if a deal like that were able to be structured where they get the capital in exchange for offtake of X% at spot minus whatever, and you look at, okay, well, let's say that they actually get into production and they have the big production via whatever method they do. Okay, well, how much could they be worth then? And you do a bit of math, and again, it looks pretty interesting to me. And the other thing that I find pretty interesting about Bannerman, and I know I've said a lot, don't worry, I'm getting to the end, is that there's kind of a positive feedback loop here, in that now it looks like, okay, 75, is it ever going to get to 75? But as we get closer, it begins to look like, okay, well, maybe go to 80 if it goes to 75. And in my opinion, the reality is, let's say a Tango needed 75. In reality, if the market decides, hey, we need a Tango at 75, it's probably okay, well, we just want something, and if it's 75 or if it's 90, it's not the huge difference at that point. Because once it gets to that point, the market is sending a very clear message that it wants more pounds. And so once you get to 75, maybe it could easily go a bit higher. And so where you have some of the lower cost production that maybe goes into production, hedges, whatever, if you're kind of patient waiting for the higher prices because that's what you need anyway, it kind of lets you see kind of how the market plays out on your way to when you have to make a decision. And if you wanted to, or if you thought that the price was going even higher, well, if there was a demand when the price got to 75, well, you could say, we'll take 90. Again, maybe not. Maybe there's not the demand. Maybe the price is at 75, but there's not even enough demand to lock in contracts. Again, it all depends. So really, in the end, I look at Bannerman as a lot of ifs, and it can do really well if. So if there's a restocking cycle, if there's a price spike, if someone wants to buy a very large ready productive capacity, if there's a disruption, if the price moves within 2 years, if if you can think about value in terms of optionality and value in steps as opposed to hit or miss, on or off, yes or no value. And that's it for today. Thanks everyone for watching. I feel like I said a lot in this video without really saying anything in this video, but I feel like at the same time, I also explained what I kind of needed to say about Bannerman. And with that, I will leave you until the next company, the next time. And until then, have a great day.